Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of February 8th, 2026. And in this week's episode, we are going to do the final installment of our investor mini-series. It's the 5th episode in that series, and it is where we bring all of the previous episodes together, where I am going to take you through my portfolio strategy for my investment and my retirement, because that is where I keep all of my investment length time frame things. And I'm going to walk you through exactly how each of the previous episode steps have applied to me and my situation, so you can see a realistic example of how those things come together. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. In this week's episode, we are going to tie all the previous 4 investor mini-series contents together in how they apply to myself. So my long-term investment portfolio happens to be my retirement portfolio, and I'm going to talk through each of the previous episodes' content and how it was applicable to my situation and my retirement, starting with how I just got started. Then we're going to move to where I went through to define my risk appetite and the asset class distribution in my portfolio. We're going to talk about how I put that money to work. And we're going to talk about how I measure that performance, the frequency in which I measure that performance, and where I make adjustments and tweaks. And we're going to do all of that so that you can get a tangible example of how the previous contents actually apply to an individual and their investment strategy. So getting started, that is step 1. And for me, that basically began with the acknowledgement that it was time to prepare for retirement, such that while I am working towards that retirement goal, prior to retirement, I'm building up a nest egg and wealth building that will continue on to carry me through retirement and fund all of the different activities, ambitions, and life post my working career. And so the focus for me when we talked about setting the goals to get started is you have to decide what is it that you are going to be investing for. So for me, the investment time horizon was retirement. Now, because it was also retirement, the investment vehicle that I chose was tax-advantaged accounts. And there are several different tax-advantaged accounts. We have talked about these in other weekly episodes, and we also touched on this a little bit when we talked about getting started, because depending on your time horizon, depending on your investment goals, that really dictates the type of vehicle that you want to put your money into. And so when you talk about retirement, there's different tax-advantaged accounts. And I've prioritized up here how I decided to try to fill those investment accounts. And I've ordered them in priority 1 through 4, because these are all accounts that I contribute to, and the order in which that I fill them. So the way this works is when I first started, I prioritized that bullet number 1. And once I reached that maximum, I then went to 2. Once I reached that maximum, I went to 3. And if you reach that maximum, you go to 4. And so the order that I chose to do this was the first thing that I decided to contribute my money to was the 401k up to my company match. So I happen to work for a company that matches your 401k contributions. And that is really kind of free money. So depending on your company, it might be dollar for dollar, it might be 50 cents on the dollar, but whatever it is, that is money that they are going to add and match for whatever you put in. And so it makes a lot of sense to prioritize that first, because if that's money you're going to contribute anyway, you might as well do that up to the level that your company matches, because that is absolutely free money that goes into your retirement account that you can use to then build wealth off of. So some people, that is 5%, 6%, whatever that number is, that is what I filled up first until I reached the maximum contribution for that. Now, once I reached that maximum contribution and I wanted to continue to put money away to the retirement, I had to say, okay, well, what's the next most tax advantage situation for me to put money into? And for me, that's an HSA or a health savings account. And the reason for that is the only triple tax advantaged account. It is tax free going in, it is tax free growing, and it is tax free coming out. And a significant portion of my expenses in retirement, I attribute to most likely be medical expenses. As you get older, you have lots of medical costs and things like that. So it makes a lot of sense to me to put money in an HSA as a different stream of income to pay for that type of expense in retirement. Now, there's a maximum annual contribution limit to an HSA. So once that is full, where is the next most tax advantage account to kind of put things into? And this is really a tie between an IRA and additional 401k money. But for me, I put the IRA slightly above the additional 401k contribution. Now, this might vary from individual to individual depending on what type of investment options are in your 401k. For me, the amount of investment options in the 401k of my company is not really that extensive. They're relatively narrow. And so an IRA offered me a lot more different types of investment vehicles that I could put money into. So that's why I prioritize the IRA next after the health savings account, because that allowed me a broader spectrum. It's through my brokerage account. And so effectively anything I can trade in my brokerage account, I can trade in my IRA. And so that really opens the doors for a lot of options on how you want to construct your portfolio. And that's why it edged out the 401k. Now, you might decide that, hey, your 401k has some great options, so it might make sense for you to flip this and do your 401k as your number 3 because you've already put money into it from the number 1. And so it is slightly the drawback to my strategy here is now I have 2 accounts to manage positions in. I have what I can pick from my 401k, and then I have what I can pick in my IRA account. Now, for me, my IRA is relatively larger because of past employers and stuff like that. When I left that employer, I closed down those 401ks and rolled them into an IRA. And the reason I did that is because those investment options are much, much wider, as I mentioned already, in the IRA. And so it gives me a lot more flexibility with that cash. So unfortunately, you can't take money out, or at least I cannot take money out of my current 401k while I am still actively employed. So, that's a decision that you'll have to make for your particular situation. But then once the IRA reaches its maximum annual contribution, then I go back to the 401k because my company match doesn't actually take me up to the maximum annual contribution limit of the 401k. So I will go back to that 401k and then try to reach the maximum annual contribution there. And so that's really the prioritization of my contributions. And honestly, I did not contribute to all 4 of these when I started. In fact, it took many, many years to slowly spill over from one account to the next account to the next account. Because you have living expenses, you have other things, and you can't divert all of your money to retirement accounts. So don't feel bad if it's going to take you a decade or so to drip through all of these different buckets to fill them up. The key point is really just to start. So that's how I chose to start the vehicles and the prioritization I gave to the different account types. All right, so the next thing that we have to do is decide, great, we now have money in these retirement types of accounts, these investment accounts, but we have to decide what is the composition going to be of risk. And this is where it will vary wildly from individual to individual, depending on the length of your time horizon, depending on your risk tolerance, depending on many, 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 many factors that I can't go through for each of you. What I can say is my current percentage breakdown of this is I am relatively conservative when it comes to my retirement risk. I don't like a lot of volatility. I like a lot of stability. I don't like big price swings. It makes me uncomfortable in a retirement situation, even though I know my time horizon is longer. It just never feels good when you open up your portfolio, or if you were to open it and see that you've lost 20% in a day or 15% in a day. And so I really don't like large drawdowns. And that's a trade-off for me because that means that I'm probably going to put significant gains aside, because there is a strong proportion to the level of risk that you take to the probability of larger gains. So larger risks have more or have a lower probability, but when they hit, they're going to hit with bigger gains. And so for me, I would put myself in more of a medium risk situation. Maybe a decade ago or so, I would have tilted to a little bit higher risk. So I am hopefully about within the range of 15 years to drawing on this retirement account. So I still have pretty significant amount of time left. If you go back to the episode where we had talked about this, the calculation that I did was a lot closer to the years to retirement for the percentage that you put in your bonds for stability. So where I basically came down to is I wanted about 65% of my funds in some type of stock-based index. And the reason I went with an index is because that's where we have a lot more stability. That's where you have a lot less volatility, but you're still exposed to the stock market. That put me around a 15% bond rate. So this is where you're very, very stable. And as I approach retirement, the percentage in bonds is going to increase a little bit. So where I'm at right now, it's about 15%. Like I said, 10, 15 years ago, it was closer to zero, and that stock was a much higher percentage. Now, because I still like a little bit of risk to try to capture some moonshots, if you would, or some up-and-coming technologies, I leave about 20% of my retirement portfolio for what I would call risky stuff. And risky stuff might be individual stock names, or maybe it's a little bit of crypto assets. And this really varies wildly from quarter to quarter, depending on what's happening in the market. Where are some of these opportunities? But it's a chunk of money that I carve out for much more speculative plays. So that 80% of that 65 and 15% together are kind of the steady eddy weighting in the portfolio that are going to hopefully carry me up and to the right. And then that 20% is where I'm hoping to get a boost or a jump based on some of the bets and some of the investment options in a smaller percentage of my overall trade. And so that's not 20% in one particular risk bucket. So it's not like I take 20% of that and put it all in Bitcoin, for example. I'm going to carve up that 20% and say, okay, maybe 2% goes to Bitcoin, maybe 2% goes to Tesla shares, maybe 2% goes to some, quantum computing company or something like that. And that is really where I kind of carve up that portion of that portfolio composition. Now, this is going to bring us to choosing the products. So that previous set was just what is the category of assets that I want to break into, not exactly the individual products. And so kind of like I showed you in that episode of really screening for what you're going to put your money to work in, I leverage Morningstar reports. So I used a lot of the Morningstar screeners to kind of zero in. And the first thing I wanted to do for my stock exposure on index is I really wanted to be specific on the percentages that I allocate to large cap companies, mid cap companies, small cap companies. And then I specifically wanted to call out international shares. And the reason I do this is because different parts of the economy, different, let's say, phases in the economic life cycle of the economy, in some conditions, large caps excel. In other conditions, small caps excel. And then sometimes international stocks excel. And because I'm going to go through different review processes of my portfolio, I can kind of rebalance the weighting to these different categories based on market conditions, based on what I believe the market trajectory might be. So at this particular juncture, I was really looking to try to put a lot more weighting in the large cap ETFs. Again, my goal in picking these products is largely high quality, high stability, low volatility. So I went with, gold Morningstar funds that had, 4-star ratings, 5-star ratings. What is really the top of the cream of the crop? Because I'm not picking a lot of different products. I kind of wanted to centralize based on that asset class, just kind of one product. Because the less products you have, the easier it is to run reports, the easier it is to execute buys, just the easier it is to manage. If you go too simple, then you might not get enough granularity to kind of express your thoughts and your investment ideas. And so this is for me where I landed. And when it comes to large cap ETFs, VOO was the ticker that I went with, and that has about a 35% weighting in my portfolio at this particular juncture. Now, mid caps is kind of the next bucket. I really wanted about 15% in mid caps. And for me, the ticker VO was the best product when it comes to exactly mid caps. If you looked at the Morningstar 9-box of all of these, you'll find that every one that I picked is largely the blend of value and growth. So that 9-box is basically 3 tiers of small, mid, and large cap. And then your left and right of that is going to be growth on one end, blend in the middle, and value on the other end. And so I tried to tend for the nice blend between value and growth because I really didn't want to try to differentiate and hold a growth portfolio or a growth holding and a value holding to balance that blend. I just wasn't interested in trying to track that. So I just went with hey diddle diddle right down the middle, really targeting the blend of value and growth in the Morningstar 9-box. Then the next one I have is VB, and this represents small cap stocks. And I really only have 5% in there right now because I think the part of the economy that we're kind of trending into is largely more favorable to your large caps than falling off to your mid caps. And then small caps are kind of the least beneficial at this particular stage in the economic cycle. Now, for me, it also was very important to get international exposure. And this is something that I don't know that all investors really consider, but for the most part, a lot of the ETFs in your small, mid, and large cap stocks are all going to be very, very much U.S. domestic based. But with the things that are going on in the world, economic conditions, and stuff like that, it is, in my opinion, in a time of the economic cycle where there is a high probability of outperformance of international markets. This would be markets in China, markets in India, markets in Europe. So I actually have 15% of my portfolio in non-US equities. Now, this is a blend across all different things, and the fund there is VEU. But what's very important to me is that VEU has international stocks, but it has no US-based equities in it. There are other funds that will be world funds and stuff like that that will also include US-based stocks. I didn't want the US-based exposure because I already had exposure in the large, mid, and small caps, and so I didn't want to dilute my international exposure by having some of that US-based companies in the fund that also holds international stocks. So my VEU is a very pure international stock market play. And this brings me to bonds. So for me, the bonds really come in different forms. At this particular juncture in time, I have my bonds 15% all in VTIP, which are inflation-protected treasuries. And the difference here is that as inflation increases, these these inflation-protected treasuries really kind of shine. If inflation was on the downtrend, you might want to be more exposed to straight bonds because bonds will do better as inflation is receding. If you think inflation might be on the rise, that is where these inflation-protected bonds kind of come in. And this is more of a high-quality bond because it is only based in U.S. Treasuries. It doesn't have any corporate debt. There's no municipal debt here in the bonds. So it is a relatively conservative, slow-moving, inflation-protected bond that I put about 15% of my portfolio in. And the very last category is my 20% high-risk trades or high-risk plays. And so this is various because it basically changes from quarter to quarter, time to time. There's really no consistency on what I'm putting in this particular category of the 20%. And the reason for that is It really kind of just goes by what's interesting at the time. What am I looking at? What's the moonshot that I want to go for? So historically, I have used crypto money here. I have decided to put in some Bitcoin investments, some crypto stuff. One of my speculative plays right now is in Lucid, the EV car company. They are not doing very well from a chart standpoint, but I happen to believe that their product has the possibility to kind of be one of those up and coming stocks that might rally. Of course, it might go nowhere and we might go to zero. They might go bankrupt. They might disappear. And that's why it's in this high risk bucket. I only have about 1%, 1 to 2% of my retirement portfolio targeted at that particular play. But that's the type of thing that I will put in these high risk play categories. Another one that I've deployed in here is investments in quantum computing companies. So direct quantum computing speculation, because that's kind of an up and coming industry. And so that's the type of thing that I'll kind of kick around in here. And then I'll re-review it each time that I come up for my portfolio review, my strategic review, which I'll actually talk about in the very next step. So that's really how I kind of broke down the products that were going to comprise in my portfolio. So as we move along here, this really brings us to what happens next. And what happens next is it's time to make the buys. Time to execute on this. And this is something that I choose not to try to time the market. This is something you could try to get used to be like, this is the time to execute and do much larger buys. I don't have in my, what I feel is the right insight to kind of monitor the market to know when the best time to enter is. I just fundamentally don't believe anybody knows that. And so the easiest way to kind of get around that, particularly because I'm entering all of these trades as index trades, ETF trades, stuff like that, I just dollar cost average in. Now, the only caveat to that might be in some of the speculative plays. Because those speculative plays are very narrowly focused to particular holdings, particular categories, or individual stock tickers, those I might use a lot of price action charting and say, this is the time to deploy and deploy very heavy into those. However, for the 80% that are stock indexes, both domestic and foreign, as well as bonds, those are very much a weekly buy that I put in. So every week I schedule a buy on Monday at 11:30 a.m. And so what that distribution is for that particular buy every week is executed at the market price at 11:30 a.m. on Monday. Now, how did I arrive at that? Well, Monday, just because it's the first day of the week and I can put the orders in over the weekend and just set them for execution Monday at 11:30. Why did I pick 11:30? Typically, the first hour of open in the market from 9:30 to 10:30 is going to be very, very volatile, and the actual market price is going to jump around a lot. It's going to start to stabilize around 10:30, and then it kind of gets a little bit quiet around the lunch hour, and then volatility will kind of pick up towards the end of the trading day. So I just decided, hey, I want to execute this when there is probabilistically the least amount of swing and volatility into the market. So a lot of times by 11:30, if the market's going to be trending up or trending down for that particular day, it's well locked into its groove. And so for me, just made sense to choose that as the execution time. There's other strategies you can employ here. You might do a limit order. You might set a particular price based on your price action analysis of it. For me, I wanted to just get the fill at a particular time at the market price. And so that's what executes. My time horizon is so long that whether or not I make a few pennies on the entry, it's not going to make really a difference at all in the long run. If anything, week one, maybe it swings in my favor. Week two, maybe it's against me. And the average, the law of averages, the number of occurrences really say your time of entry really doesn't matter. But it is weekly. Now, one of the reasons it's also weekly is because going back to my contributions are also weekly contributions. So there is fresh capital that is getting dropped off in these accounts every week. So it makes sense to deploy that fresh capital also weekly. The reason for that is cash, a lot of times in these retirement accounts, unless you put them in some type of vehicle, earn absolutely nothing. So most of these retirement accounts aren't going to pay you an interest rate on your cash that's sitting in there. So if you wanted an interest rate, you have to put it in some type of short-term treasury product, bond product, or something like that that's going to give you a yield. If you don't, it pretty much just sits there in cash. And for me, sitting there in cash is actually depreciating because inflation comes along year in and year out, and that slowly erodes the value of that dollar. So putting the money to work as quickly as you make the contribution is important to me in that portfolio deployment. So the very last step that we talked about in the previous episodes is kind of that maintenance or life cycle step of doing your continuous reviews. Remember, because you have to review your performance to say, hey, is what you're doing make sense for the time, energy, and effort that you're putting into it? Are you getting the value add out of this that you want? Now, for me, I do this review quarterly. My time horizon is many, many years. And for me, a quarterly, 4 time a year assessment of my portfolio, the percentage composition, the rebalancing makes a lot of sense. And so every quarter, at the end of the quarter, I sit down and I look at everything. Now, I baseline my portfolio against a 2-fund portfolio of SPY and BND. So as you know, right now, my bonds are in inflation protected, but my baseline that I've chosen is basically BND. So I am hoping that my choices are correct based on the environment, and I will outperform BND by going with my VTIP holding. Now, the other piece of equities are going to be baselined against the SPY or SPY. Now, that is going to be an index fund that is largely US based. So I am hoping that my choice of composition of manually deriving and controlling the small, large, and mid cap category, as well as adding international funds, will show outperformance to the SPY. And that's the baseline that I'm going to compare against. And then my alpha, my discrete plays, I lump that actually into the SPY percentage. So when I do this 2-fund percentage, I am doing that with 15% bonds and 85% SPY, and then comparing that against my portfolio composition, because that's going to show me, hey, does taking those speculative trades, is that contributing to a possible outperformance of the SPY? If it shows an underperformance to the SPY, then my strategy is not really working, and the SPY might provide something better, and I wouldn't have to get as cute or as fancy with my discrete funds. Now, that's if you're doing it based on return. If you wanted to go on volatility, you could compare on volatility to see maybe is the SPY volatility less than my portfolio volatility. Whatever that metric is that you're placing value in, that's what these quarterly reviews are really tagged to do. Now, one thing I want to show you here is how I decide to rebalance my particular portfolio and where it goes and what I do. And so I have a spreadsheet created, and you can see it on the screen. And I have a bunch of formulas here laid out. My categories of ETFs and stuff I have over here. Then you got my bonds. I can put different positions underneath there. Each one of these sums up, and you can see the green basically means I'm hitting my target. I put just a bunch of fake value numbers in here. This goes with how many shares do you have, what's the current trading price of that particular underlying. And this is the sheet that I will pull up quarterly. You'll kind of come in here and you'll put in, how big is your portfolio? Maybe it's $25,000. And then this will tell you, based on what you currently have, how much you need to buy and or sell. So if you don't have that much portfolio and maybe you're just a $5,000 portfolio, actually you need to get smaller than that. So let's just say 3,000. To split it up. Now I have an overweighting here in Lucid. So it says you need to get rid of 4 shares of Lucid. If you show and say, hey, I've got a $300,000 portfolio to get the percentage distributions based on the current trading price, I need to pick up 164 shares of VOO, 149 shares of VO. So anytime I change my percentage allocation in my portfolio based on my current holdings, this worksheet then tells me how much of a particular position do I need to buy or sell. And so as a quarter goes by, maybe the large cap outperforms and you are now overweight on large cap. So you have too much there. So you're not actually hitting your percentage. Maybe small caps underperform. So the distribution or allocation of money is less than that in your small caps. What this will do is on this worksheet, it will show you, hey, you need to sell some of your large caps and buy some of your small caps. And this worksheet largely works all of that out. It's very simple. You just put in the percentage allocation that you want, and then your quantities of shares that you have, the current trading price, and then math does all these things in the formulas that I have in these cells. So here it says, hey, this is the adjustment price. Adjustment price is the one cell minus the other cell. And then here is the cell divided by the other one to decide, how many shares do you need to buy or sell. Now, this is also useful when it comes to weekly contributions. And so if I come down here, I can choose, hey, here is my weekly contribution for me to hit those targets depending on how much money I have in my weekly contribution. Let's say I have $1,500 to deploy in my weekly contribution. I'll put that at the top. And that will tell me, hey, I need to buy $525 of this, $225 of this, $75 of this, $150 of this. And then that will tell me then how many shares, given that current trading price, do I need to buy. So maybe I have, $6,000 to do. And now I got to buy 8 shares of VEU, 3 shares of VOO, 3 shares of VO. And so you really can tailor this to whatever that weekly contribution amount is. And maybe you don't actually have enough in that contribution to make a buy, so those will be 0 because it says, hey, you got to put $175 to VOO, but that is significantly more than the current price of $633, so you can't buy a share, so you get 0. However, you can pick up, $50 worth of VEU. It's trading at $77, so you buy one of those. And it's this formula that really drives how I make my rebalance decisions and how I make my weekly buys. So the top part of this is where I put in my net liquidity value of my retirement portfolio. And then this tells me, hey, to rebalance it based on the percentage allocations, this is what you need to do. If I choose in a particular quarterly review, I said, you know what, large caps are a little bit too heavy. I need to back off my large caps. Maybe I want to put 25% in large caps. Okay, this is going to flag me and say, hey, you're only allocating 55%. So that means I've got to pick up, 10 more percent on here. So maybe I'm like, you know what, let's pick up small caps here. By 10. Well, I'm still off by 50%. So it's red. See, he says target is 65, but I'm at 60. So maybe we take that up to 15%. And then I'm good. This is a fully 100% allocation. And then you can go over here and it tells you what I need to buy and sell based on the allocation. If you over allocate, it says, whoa. This is an over allocation. You're allocating 110% of your funds. You can't do that. And you can see which one of these sections is off. I got 75 up here, but target is 65, so I need to come down and make my changes to bring that all into compliance. And so this lets you take all of those decisions that we've made prior to this as far as the percentage of the type of funds. And then you can make tweaks in here on the exact allocation within that category. And it really just kind of helps you see how do you divide up all those funds. Now, the other piece that I'll do in the quarterly reviews is I will take this portfolio composition. I'll go into that portfolio visualizer that I showed you in that episode, and I will do a comparison between that reference portfolio of SPY and BND compared to whatever the allocation happens to be in my retirement portfolio and see how am I doing historically based on that. And then I also look at the Monte Carlo simulations moving forward to decide, hey, where is the probability of that going forward? And so anytime I make tweaks or changes, I'm looking at both that. When I make changes, I look at the Monte Carlo moving forward. when I try to reflect back, hey, is my strategy working? Am I beating my baseline? Am I beating the more simple thing? That's where I look at the portfolio comparison historically through the back testing. And I do use Portfolio Visualizer for all of that. So that brings us to the end of this week's episode, as well as the Investor Miniseries 5-episode series. All of this is now concluded. Hopefully, you have learned something along the way. I encourage you to kind of go back to different categories in the series that you wanted to rewatch or hear for a second time to zero in on that. I believe that I have laid out a lot of the individual steps, the big chunks that you really have to look at to kind of navigate yourself to an investor mindset. And it's really about simplifying all of that things down into what you're comfortable with. And what's most important above and beyond all things is just to start. Once you start and you take those steps, whether or not they're small steps or big steps, as long as those are steps in the direction of dripping money into your account, making choices on what to put that money in, and constantly reviewing and iterating on that, that is how you build wealth. Sitting and staring at it and being paralyzed by the number of choices, the confusion, all of that stuff, that doesn't really help you build wealth or kind of move the needle forward. And yes, it might be scary, but that is why you do it in baby steps. You make these individual small decisions on squirreling away maybe $20 a week, maybe $50 a week. And once you have enough in there, you can choose, hey, you know what? Let's just stick very simple and let's buy SPY. Maybe you just want to keep it, just stock index, and you just buy SPY weekly. And maybe that weekly buy is just a $20 buy of partial shares. And it's that wading into the shallow end, the zero entry pool, just slowly. You don't have to go to the diving board. You don't have to jump off into the deep end. You can go as fast or as slow as you're comfortable with. But the key point is just start. And hopefully the final episode in this of where you can see it to a practical and tangible example of how all of the previous episodes lines up to my portfolio and how did I actually incorporate that? What do I do? Hopefully that gives you some insight that this is a very real, very easy, low stress type of engagement. And while it might be uncomfortable, again, this is not something I woke up one day and went zero to hero on. This is something that I slowly built years over years over years. In fact, investing in retirement is something that well predated even my interest in trading on the normal channel. As you might know, my normal channel trading, I really got started in 2019. I was putting away money in 401k and retirement back from when I very much started my career decades ago after college. And yeah, did I put it in anything fancy? No, most of the stuff was kind of ETFs, index funds, mutual funds. Did I know what I was buying? No, not really. But I looked at it back then, it was only annual. And then I just started poking on where I was curious about and learning more. And so it's really kind of about just starting. And then wherever you have a question, write down your questions and just tackle one aspect of those questions at a time. Don't try to answer all of them. Just set some of the other ones aside and say, you know what? I've got the basics here. I'm going with the basics, and then drill into the things that interest you of the question wise. And then just that organically will help you grow as you get more and more exposed. And the longer you do this, I am very confident that the more you will realize that there's no magic sauce to this. There is no person that has some magic skill because he's smarter than you. I think a lot of this stuff is very simple, and the average person is very capable of learning it. And I just don't think I can convey that or convince people of that until they try it themselves. And, maybe you're not the type of person that will ever be convinced of that. And you go with a financial advisor or a financial planner. That's perfectly fine. But do make sure that you are measuring their performance against a baseline, and make sure that you're convinced that the cost of whatever that is a value add based on the results that you're seeing. Because if you don't check something, if you don't baseline it, if you don't compare it to something, then you don't really know if you are doing better or worse than you could have. Is that extra cost, whether that's time, energy, money, whatever that cost is measured in, is it worth it? So hopefully you guys got value out of this series. Hopefully you get interest and you go out there and you start building generational wealth for yourself and passing on to future generations. Good luck out there. Have fun. And remember, think outside the block.